All right, stocks continue to be kind of in this pause mode. We had a significant down day on Monday, and then yesterday and today we're kind of stalling at a pretty significant support level. So I'm going to talk about where that level is, how important it is, why, what the other indicators are suggesting, whether or not this is still a tipping point, like we talked about on Monday, whether we bounce up or not, or we break down, and how likely we are to do either one, and what the significance are is, especially of this election coming up. Now we have a couple more days left here this week, and then one last full week in the markets next week. How did we do in 2016 in this environment, and are we setting up a similar environment now as we did there? So I'm going to kind of show that as well. And in today's trade idea, we're going to look in an area of the market that hasn't been doing too well in the last week of weakness in the broader market, and we'll talk about how to use it as a hedge for us, to give us a hedge type of a trade in an area that doesn't have a great margin of safety. So let's go ahead and get started. Today is Wednesday, October the 21st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see another small range after Monday's bigger range. We've had two consecutive days where the range just got smaller and smaller. Yesterday's at 41 points, today at 31 points. So very small range. It's down day, so this is like our fifth down day of the last 7 sessions, and closing slightly below that 62% after bouncing up from Monday's close, where we got into the retracement zone. Remember, you get down, you get down to this 23% retracement. There's not a lot stopping it from going up or down in this area, from the 0 to 23 level. You can see the intermediate lines falling again, still above the market sentiment, but the market sentiment's falling too. So, it's unlikely, depending upon how we. If we break back down, it took a while to break up above this kind of 34.30 level. This area here took a gap up there on the 8th to break above it on this kind of parabolic move that we talked about before. So we kind of have to really break back down below that 34.30 before things really get significantly bearish. We'll see if that ends up happening or not. So there's a little bit of weakness here overnight so far in the futures market. You take a look at the near-term line. This was something we talked about in class today. We've had 6 days now where the near-term line stayed below 50. If you go back on other periods, like for example this one, we had 1, 2, 3, 4, 5. This one ended up being 6 days before we bounced up. We got below the moving average there, so it's kind of rare. Even over here where we had one little bounce up above, it's rare for the near-term line to be below 50 for so long, and be above the moving average. Kind of shows number one how big that parabolic move was there, and maybe it was too much, right? And then also kind of shows, as we've been pretty bearish, we haven't been as bearish as we could be. Holding that support at this old high point where we were kind of struggling for a little bit to get above, and now holding it for support. Old resistance becomes new support kind of a thing. The momentum line, you notice during this rally, we've had some drops, some relatively bearish days right there, and then right here, then a couple right there. This is the first one to get below that 5th percentile. That's what this line's at, the 5th percentile. We haven't had a drop below the 5th percentile since, again, we were below the moving average here and here and here. All of those drops got below the moving average. You can see some others where we were bullish, where you were up above, but even that one was below, and then that one got really close to being below. So here's some bearish days, and today it actually wasn't nearly as bearish as it could have been, but finishing well off the high and a lot closer to the low point than we have had previously. Take a look at the Russell 2000, which has actually been more bullish than the S&P. It's got a strong bullish posture still. It's got dark green shading and a green line. None of the other indexes have that. They're all green lines and pink shading, but the Russell still got the dark green shading because while its intermediate line is falling, it's still above 80. So that's how bullish it's been. But look at that short-term sentiment dropping pretty sharply. That near-term line is at its lowest level during this whole decline. Like, it was never that bearish here. And the last time it was that bearish was during this pullback that started that, kind of that parabolic move and then the correction, and then we went sideways for a while. So it's a relatively bearish near-term sentiment there. Again, doesn't look as bad as it could be. I mean, obviously that looks like a much worse scenario. Even that period, we were this bearish in the near-term line. That even looked a lot worse than what we're seeing right now, as we're just kind of barely grinding down here. But it kind of goes to show again, kind of how tenuous things are right now for all these major indexes on their market forecast charts. You get these indexes like the NASDAQ to get their intermediate lines to fall back below. If we break back below these highs, in the case of the NASDAQ, breaking back below, this kind of 11,600 level, acting as a support, that's going to be significant for it going forward. And the same thing for the Dow, kind of in this 2,800 to 50 area, and then of course the S&P in this 3430 area, all acting as support that you would expect to hold until it doesn't. But I think the likelihood of it not holding, considering the market environment, is rather high. That I would actually expect this one not to hold in this case. It seems like there's a lot of pressure. We got down to it Monday, and then every time we come up off of it, we come right back down to it by the end of the day. So it seems like it's trying to hammer away at that low point price action is, and we'll see if it finally gives way here overnight and into tomorrow morning. Remember, we haven't really, the other thing too about this decline, we haven't really had a significant bearish gap. Is the biggest one we've had lately is right there on October the 15th, and we ended up only down just a little bit on that day. So we haven't had that big down gap where we finished the day down relatively sharply. It doesn't even have to be a 3% drop, but kind of in the 2% mode to where we're really bearish, kind of breaking support. So look for that potentially tomorrow or Friday by the end of this week, as we head into a really important week next week, the last full week before the election. Or excuse me, you actually have 2 weeks here with this, the way the cycle. No, actually, no, we only have next week is the last full week before the election. So it's lining up very similar to how things were in 2016, and that was a relatively bearish week for the market in 2016, heading into a rather uncertain period then, and a lot more uncertainty this time around. Before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos get posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our videos today, and you want us to do another video again tomorrow. It's a great way to give us feedback. If you don't like our videos, of course, you don't have to click on anything or even watch for that matter. But if you do like our videos and you want to let us know, you can do it with one click right now, even while you're watching. Also, while you're down there, comment. What did you like about our videos today? What did you get out of them? What questions or comments do you have about anything I talked about in the video tonight? Post all those in the comments section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content, and between the videos from day to day, there's my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching on our blog here, I invite you to check out our Market Outlook live video. I actually still get asked about this quite a bit, about going back and reviewing old trades. I do that in these live videos. I post them at 3 every day. I do the Market Outlook. I do a live video at 3:30 Eastern time. I review all the old trade ideas that we do here, and I put on today's trade idea before the market closes. So you can get those there in those videos. Again, that's available for all of our plus, our monthly subscribers, as well as our premium subscribers. There's our classes that we have coming up. Our Q&A sessions are also available for our premium subscribers, while all of our trading rooms are available for both our monthly and our premium. If you come down here, click on this heart. That opens up a new window. Click that like button right there. Also, come over here, click on this thumbs up. That will take you to your Facebook page. Click that like button there as well. Again, the more you do that, the more likely more of our followers will see our content because of the engagements it has. So it benefits us. It also benefits you because Twitter and Facebook will promote content in your timelines from the content from the accounts that you engage with the most. So we invite you to do that. Also, come over here and you can share our content on LinkedIn or on Twitter or on Facebook just by clicking any of these icons over here on the left. All right, now let's get to our weekly chart, and you can see here, I mentioned on Monday the idea that we can have a transition type candle here, and so far that continues to be the case today. Lower high point, much smaller body, obviously a lower close, an upper and a lower shadow. Again, with a high PPO that's rolling over just a little bit here as the 200-day continues to rise up. And it's now close to that 23% retracement level. That's a really high level for the 200-day moving average to get to. And you can see how much closer we are getting to the 50-day moving average there. But there's an opportunity here for a little bit of a small divergence to play out back down to the 23%, if not, as I mentioned before, a little bit lower down to this 3130 level. So it's about 300 points away or so from where we're at currently. If we take a look at the green arrow here, the 3 green arrow chart, you can see we got 2 red arrows. We don't quite have the third on the moving average yet, but we have 2. And again, that brings to mind this idea that we could get that third one here if the support fails to hold. If you take a look at the 2-line versions, we are below the 8-day moving average for a third straight day. We did bounce above the 17-day briefly, but you can see the long upper shadows and why we got such a bearish market forecast today with how close we close to the low of the day and how well off the highs of the day we finished. So again, how important this 3430 level is, because that's also where the 17-day moving average. The MACD is below its moving average, stochastic's below its moving average, back down below 60. So we'll kind of keep our eyes on these oscillators, especially when you look at like the RSI, still holding up above 50, but breaking below the midpoint on the CCI, and then the DMI. You can see the negative index not, pulling back down a little bit while the positive index is holding up. So, this like we talked about on Monday, we're kind of at this point where, we either bounce off of this and everything's great, or we don't. And right now we're not bouncing. We haven't broken, but we're not bouncing off of this either. And it's tried multiple times and failed. And we continue to finish at the lows of the day, which obviously a lot more important. Where do we close? We close at the lows or the highs, and you can see for 3 days this week we've closed near the lows of the day. So it doesn't guarantee anything. Doesn't mean we have to fall tomorrow or Friday, but it kind of gives you an idea that the odds are a lot higher because of how we're closing lately. Of course, this all depends upon, the stimulus deals and whether something gets passed. But I think even if something gets passed right now and we get a short little pop, it'll just be a knee-jerk type reaction and we finally get through it. The market's been waiting and waiting and waiting for something like that to happen. Obviously, it's not going to go into fruition anytime soon in the next day or two. So I think the news of it will be initially positive before we're back to the reality of a looming election here in just a little over a week, with one more full week left next week. You can see how we're closing, how every time we rally, it just fails. We rally and it 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 fails. That's been a constant pattern over the last couple of days, trading at the lows of last week. After breaking below it on Monday, we're still trading around those lows with some gaps left to fill. We still have to fill in the rest of this gap here that we didn't quite get to on Monday, and then of course this gap over here all the way down to this 335 level. So again, with this gap in volume below yesterday and today's and Monday's low, you can see again how easy it would be to for this to break, especially because we're hammering away at it multiple times. When there's not very much support below it, I wouldn't expect it to continue to hold up. So that sets us open to move down to 336, 337, down into this 335 area where the point of control is. Of course, you break that, and now we're looking at a move down, back down to the 23% retracement, if not eventually all the way back down to, as I showed you before on the daily chart, back down to the 323 level below the 23% retracement, if not down all the way to 314, 315, which is, in my opinion, the worst case scenario on any kind of pre-election or even post-election pullbacks. I think there will be some volatility heading into and potentially afterwards as well. We'll kind of see how this plays out. Another reason why we're kind of holding support here is it's the top of the value area, and there's a pretty decent volume node here. So that's why we're not like free falling. We've got some pretty good margin of safety on the S&P. Obviously not as good on the NASDAQ 100, but it's getting better. We built up some volume here over the last few weeks in this area, so it's not as bad from a margin of safety standpoint as it was. And again, even a move there down to this 23% won't be like a free fall, because you got a lot of volume, even all the way down to closer to this 258 level, the top of the value area where we got down to previously on the last little pullback, in that September decline and the subsequent bounce. But if we were to kind of double top here and work our way back down to that area, there's a pretty decent support down there too. I showed you today's volume was relatively light, 63 million, so below the average, and the range also just a little bit above the average after a below average day yesterday. So when you look at those numbers in context here, again, the volume, the ATR is still kind of steady. We're not pulling down to where we're bullish again, but we're also not breaking out either, and I don't expect that we'll break out with a sharp move. The volume is relatively steady too, below this 100. I do expect that it would get back up to the 100 level if things are going to really pick up over the next 10 days or so. 7 or 8 trading days before the election. Then you look at the volatility index and you see how it's just grinding higher. I think we will end up at the highest point by the time we're done with this intermediate pullback that started in September, that I don't believe that we're actually done with yet. So this is where the intermediate pullback started, and that was the worst case in the volatility so far. I think we're going to eventually head back up into that area, if not a little bit higher up to 40, but we'll be up in this area again. With this time, you can see we'll be up to the 105% mark, if not a little bit higher, where we weren't this first go around. And then that's when we'll know we're at the end of the rope. And you'll probably also see too, by the time we're done with this pullback, the negative index getting closer to 40 than we did initially, and then the positive index getting closer down to the 10 mark, which is generally what happens by the time this kind of pullback is all said and done. I mean, again, I used last May as a good example, where we had an initial kind of drop and then we bounced. We didn't get above the moving average like we did this time, but then you can see the worst case scenario, that we got the highest peak and the lowest valley on the positive index at the end of the intermediate run, because we didn't really get a big sharp move early. And same thing here, we didn't get a big sharp move early. So I expect we'll see an even bigger gap than this. It might not get all the way to 40, might not drop all the way to 10, but we'll see a bigger gap than this by the time all is said and done. All right, before I look at some other charts here, just to summarize the technical outlook, we had a down day Monday, and so far the last couple of days, and as I mentioned on Monday, we could either bounce off of this and great, we get this intermediate run going, or here we go, or we break down, and we've done neither. We haven't bounced up, we haven't broken down either, but there's some pretty decent support where we're at, and we've been hammering away at it, kind of chiseling away at it the last couple of days, yesterday and today. I think it's likely that as we break through it, now again, I'm not talking about fall off a cliff support breakout, but as we break through it and continue to grind lower ahead of November the 3rd, then we'll end up with the scenario where the indicators look the most bearish at their lowest points. Again, similar to May of last year, similar actually to November of 2016 when we had the election there, and things bottomed out, those 2 days before the election on Monday and Tuesday. Before Wednesday, we bottomed out and started a rally from then on, going into November. It might not be as quick this come around. Again, no matter who wins, it might not be as quick this go around, because we might not end the night with a clear winner. So that remains to be seen. And if it does, it just means that we might have some more volatility, some up and down, depending upon the news cycle, some up and down moves for another week or two until we finally get some results. But very similar type of pattern unfolding now as we saw then in the last election on the markets, where we know we don't fall off a cliff, and there's no reason to fall off a cliff this go around, but we continue to kind of gradually move lower as we get bearish news here and bearish news there. As markets kind of looking for that October surprise, so to speak. And then the worst is going to be at the bottom. Unlike normal other intermediate pullbacks, where the worst is kind of at the beginning, and then we slowly move lower after that. But the worst of the selling, the kind of big bulk of it, occurs really early. In this case, it looks like we'll grind our way to the worst at the very end, and then we'll bounce off of that. Whenever that is, whether it's November 4th or whether it's a week or two after. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree, as to why you're either a lot more bullish than I am or a lot more bearish than I am with whatever charts or indicators or that you're looking at that suggests for you to have those expectations. All right, now let's talk about what's driving the price action today. And look at these big moves on bonds and on the dollar in the last 3 months. This is a 3-month chart, but in bonds and the dollar. And then, but you notice that even with the weakness that we're getting from this October 12th high point, where everything from a risk appetite standpoint has been dropping, except for emerging market stocks, these other asset classes, safe haven asset classes, are not dropping. Gold's actually rallying. Gold's rallied a little bit on the weakness in the dollar. Commodities are up a little, but you can see equities are all down, and the dollar is down and bonds are down. So it's kind of like more of a broad selling. If I just look at the last 3 days, right? So Monday's loss, and then the last couple of days where we've just been kind of hammering away at support. So we'll go to from Monday here. Let me change that time frame to. We'll go to 15-minute chart. So there's gold and emerging markets holding up the best because the dollar has been so weak. And look at small cap stocks and QQQ both really struggling this week. Again, the worst of it early and then just kind of hammering away. But you can kind of see, again, even look at bonds down there. Bonds down at their lowest level of the week too. Again, you would think that the dollar and bonds would be up here with gold. But this is a really kind of a shift out of dollar-based assets into international assets, and that, it's only a 1-day shift, and you can see the yields moving here. And I don't expect it to last too long per se, but in the short term. But from a longer-term standpoint, outperformance by emerging markets and international stocks in general, but emerging markets specifically, is definitely a possibility when you look at the direction of the dollar. You can look at that move by the euro. After getting down to this breaking the 23% retracement and working its way back up. So if I were to kind of redraw some of these lines here, Fibonacci, and go from, let me just make sure I've got it snapping here. If I do. Okay, so if I were to go up here to the top and work our way down to the lowest point here, you can see that we have bounced up to the 23% retracement, the black line here. We got up into the retracement zone. It's kind of hard to see with that other line. So let me get rid of this one here briefly. There we go. We got into the retracement zone, pulled back down below it, back down to that 23% retracement from both these levels, both the 23% of the rally and the 23% retracement of this decline here. We held that for support and now bounced up through the retracement zone. And that's not enough yet. That's why I say, in the short term, this little strength might be a little short-lived because, you can see there's a little bit of resistance here. And if there does continue to be some weakness, don't expect the dollar to continue to underperform so much and for bonds to underperform so much. So bonds are breaking down below really important levels. I've shown you this chart before for bonds, long-term bonds. I mean, they're breaking down into an area of volume that very, very light volume. Here's the volume on a 5-year chart. You can see again just how light the volume is in this area. So we're in an area for bonds where we can drop into the retracement zone, to the bottom of the retracement zone, the 140, really easily. Of course, I expect that will happen more on when we have more of a move in risk appetite to the upside. But you can kind of get an idea that, inflation expectations are rising, bond yields are rising too, and that's bearish for bonds. And that's not a bad thing, right? That's the Fed's not going to raise rates. I mentioned to you before that back here in 2000, and here I need to go to like a weekly chart. But back here in 2013, remember the overnight rate was at 0%, and we weren't at 50 basis points back there. In fact, with QE3 on the table, we eventually got up to 3%. The 10-year note got up to 3%, with the overnight rate still at 0%. So we're at 80 basis points right now, and we're working our way towards 1%. Not out of the realm of possibility whatsoever that we work our way up to 1.5%, 2% again, without the Fed doing anything. And that's not a bad thing. Again, the worst thing is for us to stay at these levels, because that signifies deflation, and that's the worst thing. The Fed can't deal with that. They don't know how. As you see with Europe and Japan, they went negative rates because they don't know how to deal with deflation. But they do know how to deal with inflation. That's a lot easier to deal with and manageable, because you can raise interest rates until you don't have it anymore. But you can't, as we've seen, you can't lower interest rates enough to stoke inflation, to avoid deflation, as again we've seen in other areas of the world that we started to see here. But a little bit of England, that's a positive development. We had a big move in yields briefly, but that immediately reversed back down, and this has been a little bit more solid of a move as we're gradually starting to get a little bit of a bullish pattern here. Like, we got green line, and we're about to get dark green shading again on a weekly chart, which is a lot more significant than, say, on the daily chart. As you can see, when you get those dark green shadings and green lines, we can get weeks where the yields stay bullish, and we've got a lot of room to run. Like, these are small ranges because of convexity. You would expect in bonds, where the moves are bigger at lower yields than they are at higher yields, you can expect bigger moves here until we get back up into these levels. As you look at the sector performance over the last 3 months, again, you can see how weak energy continues to be during this week. And in fact, it's since that October 12th high. In fact, let's just go here we'll go to October the 12th till now, and let's go to like a 20-minute chart here. And actually, let's go to the 13th, because the 12th was the last update that we had. All right, so we gapped down a little bit on the 13th, but since then, that's when the rally, the pullback started. You can see during that pullback, energy has been the biggest loser from October, all the way down till this low point, and then the up and down move since. So utilities, not surprising, is an outperformer. But interestingly enough, communication services, despite the issues that are going on right now with Google in particular, big rally here back up to some stronger levels. Materials holding up too. And again, seeing those areas again suggests weakness in the dollar. You would expect those, and usually energy too, but energy is just embattled by weakness in the dollar there. So when you look at industrials and materials added on to that, those are the areas you expect to do well in a weak dollar environment. And even with the weakness in risk appetite as a whole right now, they're holding up better, as you expect they would. And not surprising to see staples and utilities outperform too. Usually real estate's up there. Healthcare usually does better too, but healthcare's got its own issues with what's going on with the vaccine and coronavirus. But you can see technology is getting hit pretty hard, and technology is actually trading at the low of this cycle, whereas some of these others are well off there, like communication services are well off their lows. Right? If I were to come back to this low point here, starting on the 20th, the 19th being that low point, the subsequent rally, and then come back down, you can see, what's been, that communication services has had a nice couple of days. But technology is down. This is just off of the Monday, off of the Monday low point. So if I were to include Monday in this, there's Monday's move included, and then the rest of this week, discretionary communication services, but technology and even industrials now in healthcare showing some weakness here. So, again, we've talked about the leadership being in the technology space, and if technology continues to be weak, and no matter how great industrials looks or how great some of these other smaller sectors look, if technology and communication services are unable to maintain strong outperformance, then that's going to lead to weakness, because that's the leadership. We're not going to get any significant change or rotation here. The leadership is going to be what it is until we get to another stage of the economy that's post coronavirus and COVID, where the vaccine is here and there's not an issue anymore. Until then, the leadership is what it is. It's not reflective of an overall small business type economy. It's reflective of the work it from home and the 5G rollout and more automation and cloud services and things like that. That will continue to be the type of economy we are gearing up towards, with acceleration in those areas because of coronavirus, until we're done, right? Until we pulled everything forward and we're done with coronavirus and we move on to another stage of the economy. And that led to, once we got through Y2K in the year 2000, that led to some weakness until we got to the end, to 2003, because we had pulled everything forward from a capital spending standpoint in technology space, ahead of 2000, ahead of Y2K. So we're seeing a pretty similar phenomenon here, that eventually, you'll see like technology is a big part of the S&P 500 right now, and other areas aren't. But that's going to shift because we're pulling so much forward now. You'll see some other sectors. I don't know if last time it was financials that took off. I don't know if it'll be necessarily be financials again, but we'll see another area in the market that's currently really small take off and move up towards the top of the list, whereas technology, which is a huge area in the market right now, will work its way back down because of the pulling forward that won't need to, that we won't, we'll have some weakness in those areas once we don't need to pull it forward anymore. All right, and that brings us to our trade idea of the day, and I want to take a look at a stock that is not doing so hot here lately, and that's Fastly. Fastly had a great run, has had a great run during this work from home, going from 13. In fact, it dropped all the way to actually down to $10, and then worked its way all the way up to $130 here, getting these clusters. But then we broke down a week ago, and we're getting an oversold cluster there, and it's holding, as of right now, is some pretty significant support with a breakdown the intermediate line. And you can also see too, from a Bollinger Band perspective, we are breaking below the point of control right now, and kind of at this point where we either hold or we break down. And if it breaks down, because we moved up so fast, there is not a lot of support down here at all from a volume standpoint. It makes it very easy to fall down if that ends up being the case. Doesn't mean we have to fall, but and even this gap up here is going to be hard to fill in because we got a lot of volume now above us to work our way up above and through before we get to the upside. If you take a look at some of these oscillators, you can see kind of another situation where the worst of the selling might end up being at the end instead of the beginning, because you notice we didn't break down below negative 200. We didn't break down below 30 here. We're just barely getting below 40 now. If you look at the DMI on this, you can see its negative index has made it pretty high, but the positive is just barely crossing below 25. It's got a lot of room to go before it gets to, again, it's potentially worse scenario during this pullback. So there's an opportunity here for things not to be so good for a company like this, especially coming in the earnings that it has coming up. It didn't have a great response to last earnings, coming off of a parabolic move. Might be already pricing something like that in this go around. But again, with the lack of support and knowing that this is kind of one of those stocks that have been pretty exorbitant lately, that doesn't have the greatest margin of safety. So if the stock does break down, then can we trade it, right? Can we trade it with a bearish trade? And what we did, so we ended up buying the $65 put. We're trading at about $80 now, but buying the $65 put, selling the $60 put. So that puts us down in this area. So for smaller than half of my normal risk, we got the potential of getting about 3 to almost 4 times as much reward on a worst case scenario. If it bounces back up, then we could end up taking a couple $100 loss, and now we're looking at about a 7-to-1 reward to risk ratio in that case. So really good. If we break into this volume area, this gap, we have an opportunity to have a hedge, on this trade with a small risk. And it's a hedge trade, so it's more likely you'll probably lose 100 or 200 bucks in this type of position sizing. But in the case where things break down, if the market gets a little bit more bearish and a stock like this breaks down through its earnings into an area where it doesn't have a lot holding it up, then we have a way to be able to make some money off of it and give us a way during any kind of broader market weakness to have a little bit of negative deltas, add a little negative deltas to our portfolio and have a little bit of a hedge going forward. Like I said, into this next few weeks where we might have some increased volatility, where stocks without very good margin of safeties will get hit worse than stocks like we looked at before, like Procter & Gamble and Clorox, that do have pretty decent margin of safeties. All right, you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have about our video tonight. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on Twitter and Facebook as well. Hit that or comment on our video. Thanks again. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.